Hello. Welcome to Biddles Investment Group. Think big, dream big. I'm going to record a short video as we touch on inverse ETFs. And so we want to start this from the beginning of the presentation here. I'm going to present. So inverse ETFs, let's dig in. What are they? They're a tool to make money when the market goes down, as it's doing now. And so we're going to dive in and educate you all about what these things are. We're going to cover a basic ETF, then we're going to move into inverse ETFs, how they work, when to use, and the risk of these. This is Think Big, Dream Big. We want to push our limits with the Push Our Limits shirt. Can't see it because of the background, but this will definitely help you to push the limits in your investing journey. So what is an ETF? Definition is exchange traded fund. It invests in a group of assets like stocks or bonds and is traded like a stock on exchanges. An example is the SPY, which tracks the S&P 500 and has many stocks held inside of it. And we can take a look at those in a minute. So I'm going to review the charts towards the end of the video. And how I use the inverse ETFs. And so if you want to fast forward, but this information is definitely important. We cover a lot of information. It's very risky. And so an inverse ETF is an ETF designed to move opposite to an index or an asset. If the S&P 500 goes down 1%, an inverse ETF may go up 1%. It's very useful in bearish markets or for hedging. So, in short, making profit from falling prices. If the stock market rises, these inverse ETFs fall. And so we know over time, the market gives you about 8 to 12%. So these things are definitely falling over time. Now, when the stock market falls, these inverse ETFs will rise. How do they work? So they use derivatives like swaps and futures. They're typically designed for daily inverse performance. They are not suitable for long-term holding due to compounding. So here's a grid here. I'm going to move me out of the way or to the side there. We've got inverse ETF, what it tracks the opposite of, and the ticker. And so SH is an inverse ETF. It tracks the opposite of S&P 500. PSQ is an inverse ETF of the NASDAQ 100. And DOG is an inverse ETF of the Dow Jones. And a special highlight here is SPXU. So what we're going to jump into is leveraged ETFs as well. We're not going to touch too much on it, but I want to give you information so that you're equipped with the tools to be successful. And so most of these are one times. One times means if the index, one of these indexes should fall 1 or 2%, the inverse ETF will go up 1 or 2%. You can see that this one is leveraged. Anything that's times 2, times 3 is leveraged. And so SPXU is S&P 500 times 3. So let's say if the S&P went up 1% Friday, if it went up, then this inverse ETF is going to go down 2%. If the S&P goes up 2%, this inverse ETF, it'll go down 3% because this is 3 times. So if we go up 1%, your ETF is going to fall 3 percentage points. Now, if the S&P falls 1%, you gain 3%. So you can see the risks there. So when to use these inverse ETFs? So our checklist 1 is you expect a short-term market drop, or you expect a pullback on specific securities, because there are inverse ETFs for Apple, Microsoft, Tesla. Tesla's been beat down. But if you got into an inverse ETF on Tesla, you would be about 20% up. So you want to hedge your long position. So let's say, hey, I've established a lot of long positions and now the market is falling on me. This is a way to hedge that loss that you see in your portfolio, so that you don't take such a large hit. And this is if you don't want to short stocks directly. So placing options, putting a put, a lot of complexity. You definitely have to be signed up in your brokerage. You have to be options approved. And then sometimes you have to have certain margin uh, or a certain balance available in your account in order to trade options. You definitely want to avoid this if holding long term or you're unsure about market timing. So, risk to know. There's a daily reset. There's compounding risk over multiple days. There's a volatility drag. There's leverage. If you use leverage like we discussed, it's higher risk. So, for example, we can just run through it again. Let's say you got the dog or the Dow. You say, hey, the Dow's going to go down. I expect it to go down, and sometimes we don't know this, but let's say I expect it to go down 2%. Maybe I'll get a leverage 3 times down, and then if it goes down 2%, I'm in there at 6% up if I got a 3 times leverage. I do not recommend leverage in the volatility of this market today unless you uh, are very in tune to certain securities, either the indexes or a specific security or specific sector price action. I do want to let you know that these are available for indexes. They're available for subsectors. So, like there could be a inverse biotechnology ETF. If you expect biotech to fall, you can get into an inverse ETF, betting that it will fall and that inverse ETF will go up. This is definitely not for long-term investing. So, what does it cost to hold an inverse ETF? This question comes up a lot. Definitely want to make sure that we cover this. Expense ratios or the management fee. Typically 0.9 to 1.5% annually. 1.5% is very hefty. However, when we equate it, it's, calm down, it's okay. This is automatically deducted from fund performance. The fee is definitely higher than standard ETFs due to active management. So some ETFs are automated or have robotics or algorithms, and some ETFs are passively managed, and then some ETFs are actively managed. So you're going to pay more for that human to actively be managing these, and less as the machines do their job to adjust your portfolio. Depending on what platform, what brokerage, what is available to you. An example is a $1,000 investment in an inverse ETF with a 1.1% expense ratio. It's going to cost you $11 per year. So, for example, I might put $3,500 into an ETF, and I will pay about maybe $35 to $40 for that year for use of that ETF because that's the management fee. Now, I don't hold these for a year ever. And so that $40 is broken up probably to maybe $4 or $5 or $6 because I'll hold it over a term of, even less than that. I'll hold it maybe 1 or 2 weeks. I might jump back in, but the gains that I get from it is definitely worth the expense. So what does it really cost to hold inverse ETFs? Compounding and daily reset risk. They're designed for daily performance. So you can get 1 times performance, 2 times, or 3 times. They're not designed for holding long term. Your returns may drift from expectations, and I'll show you a chart where your returns will drift from expectations. Most noticeable in volatile or sideways markets. So we're definitely going to visit that as we look at the chart. This is best for short-term plays or active strategies. Do inverse ETFs pay dividends? Yes, some do. Some inverse ETFs hold income generating assets like treasuries. This can lead to small dividends paid quarterly or annually. I would not recommend to hold these things on a quarterly or annual basis. It's a bonus, but not a reason to hold long term. An example of this is the SH. This is Pro Shares Short S&P 500. Pro Shares is the organization that offers it. It shows you that it's a short, which means we're betting against the market. We're not long. We're betting against the fall. And it's the S&P 500. Pays a modest dividend. So tips for beginners. I want to cover this. I want to jump into some charts. You don't see the fee, but it's there. Dividends are small and rare, but possible. Holding costs and compounding is going to be a reason to use inverse ETFs for the short term only. What do we want to do? We want to start with non-leveraged ETFs. We want to monitor it daily. And we want to use it with a clear strategy. What are we doing? Is it a short-term play? Are we hedging? And we want to limit position size. So one thing I like to do is do a quarter position. I'll move into a half if it starts working out. Move into 3/4 if it starts really performing. But that quarter position enables us to take advantage to exit quickly if it goes against us, to DCA in if it goes against us and we believe that there's going to be a turnaround, but this is a small uptick. So various reasons to get in. Definitely tinker with it. $100 on one just to play with it, or 50. So here's a nice grid here that we've laid out for you. We've got the feature, the inverse ETF, and short selling. So we compare this. So the feature is risk of margin call. An inverse ETF doesn't have that. But if you're a short seller, you do. Which is puts, options. Nice feature of inverse ETF is easy to access. You just buy it. Now, short selling, I'm going to move me out of the way, requires margin. Another feature is max loss. You only have the max loss of what you paid. You put in 100, max loss 100. Put in 5, max loss 5. But if you do a put option, sometimes they require margin requirements or balance requirements, and if you're doing short selling, you have an unlimited maximum loss. Now, there are some nice trading courses on Tasty Trade, Tasty Live, options courses, and this is a straight put, I believe, but you can do different legs and different complexities with the options to make it work for you. And so Tasty Trade has great courses. We also discuss that in our weekly market technical analysis overview. We cover stocks and crypto. Please comment, share this, or visit the website if you want to get in on great discussions. These happen to be some of my strategies, but we have some absolutely amazing people on these calls, and they have very good strategies. And so if you don't have one, you can test one out by joining the call. If you do have one, you can optimize your strategy with the expertise that we have on that call. So please join. We'll put the information at the end of the video. So our final thoughts is inverse ETFs, they're tools, they're not investments. Key, that's a key. Best used with a short-term strategy. We want to understand how they work before using. And so you can kind of either put it in your watch list And then I know I have a watch list with Fidelity. You can put a price in there, and then you can kind of see if it's performing according to your standards. So test it out. If you feel comfortable, jump in with a little bit of money, 50, 100, 250, till you get comfortable. And then, you can start to use these tools. If you have any questions about this, please contact us. We are here. We're available. We have consults. We have ebooks. We have courses. We have a gamut of things that you can access, free tools and resources that you can utilize, because it's our goal to help you make money. It's our goal to help you understand investing. And it's our goal to help you build generational wealth. And we know that a few ways to do that is real estate, uh, stocks, and basically starting your own business and setting up multiple streams of income. So we do have a small business course. It is pre-recorded. We have a self-paced course for starting up a business. I have a lot of assets right at biddlesgroup.com. So what I'm going to do is I'm going to take us to the charts. I'm going to stop my plug because I know you want to get into the charts. You say, Brandon, what is going on here? Get into the charts. Show me what's going on. Okay, I'm going to show you what's going on. Not a problem. So what we see here, we've got SH pulled up. I will do a technical analysis of how to draw these things, or any kind of oscillators, whatever you want. Drop a comment. I'll cover a course on it. This is how I was using these. What I've noticed is they operate in downward parallel channels. This is how they operate. You can pull a lot of them up. I've actually got a list over here. And you can see most of them are going to look like this. This is why they're not equipped for long-term investing. I'm going to quickly go to, this is my watch list. We've got, and so you did see, this is Mike's watch list. This is our stock seminar. Mike Pear and Biddles Investment Groups put on every Saturday at 10 a.m. Please join. Put a comment, put whatever. Go to the Biddles Group website, sign up. We definitely want you there. This is Google. One time bear. You can see it's down. This is Tesla bear. This is the weekly over here. This is the daily over here. You can see historically, these things are not meant to be held long term. They're not meant for that. But if you had an inkling that Tesla was struggling around February 3rd, Monday, February 3rd, you would have got in on this run here from February 3rd. We see the 4th, it went down, smaller candle. We see the 5th, it went up, and then it was off to the races. We did have a small pullback, and so this is when you want to get out of that thing. But you can see here, if we measure that out, let's say you stayed in it, stuck with it, you now have, let's say you got out towards, the bottom. You got about a 53% return. Absolutely ridiculous. How many days did that take? 43 days. 43 days. 1 month. Almost 1.5 months. And you have a 50% return. Is it scary? Sure, it's scary. It's an inverse ETF. But if you can manage your emotions, if you have a good idea that, hey, this thing, I am confident it's falling, it's not good news, sharing that 53% gain. So we've got inverse ETFs for S&P. We've got it for healthcare. We've got, I believe this is the S&P. This is the Dow. This one is Japan, China. We've got inverse ETFs everywhere. So what I want to do is I want to take you to SH. I want to show you how I use these things. Brandon, get to the meat. I'm going to get to the meat here. So we draw one parallel channel. First, I want to back out and show you these two parallel channels that I've drawn. One was working at a time. You can see this. Boom. Bounce here. Bounce here. Bounce here. Now, prices have reset. Prices have reset. We drew another parallel channel here. So you can see that red parallel channel there. You see the price hit that bottom. Boom, 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 boom. Hitting that bottom. It keeps hitting it, right? And we're reversing. So now we have a fair level of confidence that this is a good range to start to get and move into this ETF. Because usually when it hits that bottom of the parallel channel, it's going to bounce up. Now we have reset the ranges. Okay, ranges have been reset. So as long as or price ranges have been reset, because now this is out of a controlled area. So we need to wait until this falls back down and bounces to get a good price point of where we want to get in at. If you want to use this short term, like a day or two, we can get in. We got to plug up our computer here. We can get in at 44.12, 44.11, and then we can share some of that upside. So if we flip to the S&P, we can see that we are in a range here. That's the range we're currently sitting at. So the S&P, if you think it's going to fall back down, we can pick up that inverse ETF, get that good price point. If you think the S&P is going to break out, which has been struggling to do, the bears have come in and we can't break this 5,700 level. Got to break that 5,700 level, along with some of these moving averages in order to turn this ship around. If this ship doesn't turn, we need to be in inverse ETFs. And so there are inverse ETFs for Meta. For example, we see Meta has fallen the past 1, 2, 3, 4, 5 weeks. Could still fall more. Who knows? If you have an inkling that this thing is going to fall, jump into METD. So if we read it, this is Direxion. That's who offers it. It's a daily meta bear, one time. And this is important. One time, you'll see 2 times, you'll see 3 times. That means you're starting to use leverage. If the market goes against you, you're going to get hit twice. If it goes for you, you're going to gain 2 times. If it goes against you 3 times, if the market goes against you and you're in a 3 times inverse, it's gonna hit you 3 times as hard. If you're right about it, you're gonna get a 3-time gain. Fantastic. So we see the Meta Bear ETF here, and this thing is falling. We could have shared in 26% of a gain. Absolutely incredible. Wild. Wild. Could you imagine that in this market, you can get a 26% gain? Even if we didn't sell at the top, let's say we got bumped out here on this long red candle, we've got a 20% gain. And so it's very important. What I've learned to do is watch. There really wasn't any telling here because it wasn't a real resistance level, right? There was no resistance level. This thing was just shooting straight to the moon. And so, but if we do see something that has a resistance level, so let's say Microsoft. Microsoft trades in range consistently. So we know if Microsoft hits 454, even 446, that thing might come back down. We see an area at 441 here where it reverses. So reversal, reversal, reversal. This is going to be the best price for your inverse ETF. So let's look at MSFT. Microsoft Bear, one time. So what you're going to see is basically the opposite, right? Once Microsoft is hitting those resistance levels, that's here. That's here. That pushes the price of the inverse ETF down. This is where you get the best price. When Microsoft is hitting that 441 support, you're getting this $12 price on this Inverse Microsoft ETF. And so if we got that $12 price, we move up here, we've got about and let's say we don't sell at the top, but we got a nice 14% gain. Even if you get 10%, it's better than going long and sitting on losses. And so these are just tools that are out here. We want to equip you with these tools. We want to put money in your pockets through this education. And so this is just a quick little way of how inverse ETFs can be used. I'll hit the dog real quick. We'll look at the Dow because the dog has more of a controlled area. Some of these are in an uncontrolled area, and I wouldn't recommend getting into them. But you can see the Dow has pretty much been in a range. We've got this double top. We don't like that. But we've been in a range, right? So we could fall further to this 39,000 level as double tops do hit things hard. But we're going to go to the dog. Look at that. So what we're seeing is the opposite happen. We've got a double bottom. The double top on the actual index is a double bottom on the inverse ETF. And so we've got this double bottom. And so what I've drawn is a range here. So we see that we've got, the resistance area on the Dow is here. This is the best price that you'll get, 25. There are some other levels you can possibly get into, maybe mid-range. This is at the highest part of the range. Excuse me. And what I want to note is after we draw these channels here, what I've seen is most of these will bounce above a moving averages and then they'll come back down. It's not like a stock. It'll hit that moving average, come back down. So see here, we rose above those moving averages, came back down. Rose above the moving average, came back down. Rose above some of the moving average, came back down. And this is how they work. This is what I've been noticing. Now, surprisingly, in this market, with the correction that has happened, these things are above all the moving averages. So this one just came back down because we had a little bit of positive momentum. I wouldn't even say momentum. We just kind of closed up in range. So if we go back to this is the inverse Dow. If we go back to the actual Dow Jones, you'll see those green candles here. And so that's the reason of the red candles in the other one. So we might can get a good price right now on the other ones. So it just really depends. It's a way to hedge if you're losing money already, if you want to make a little bit of money, because we know that it's more than a pullback on some of these indexes. It's a correction on some of these. And we know that certain patterns have significance, like a double top. It could take us down further. And so there's still things that can happen. So, for example, this might hit this $43,000 level. We might not go to 45, but it might hit mid-range. So if we expect that to happen, we can go to the dog and we can see what our price is going to be. So if we expect it to hit mid-range, our price is about $26.50, $26.43. That's going to be a nice price to get in at. At your own risk, we are available and here to help you with these magnificent tools to help you succeed in your investing journey. So now you're equipped to not only make money as the market rises, but you are equipped to make money as the market falls. I thank you for your time. I want to wish you happy trading. I thank you for tuning in. Please comment and share, and I'll see you soon.